Something just happened in the silver market. Something most investors will not notice until it is too late. A 5-month downtrend, broken. A pattern decades in the making, confirmed. While the headlines chase the daily price, the charts are quietly pointing toward a number that could reshape how an entire generation thinks about wealth. This is not another silver spike. This is a shift, and what happens next may determine who protects their wealth, and who is left asking why they waited. Welcome to Currency Arc Insight, where we break down the forces shaping gold, silver, and the global economy. Without the noise, without the hype, just the facts that matter to serious investors. For months, the silver market moved in a pattern few outside professional trading circles paid close attention to. Prices compressed, volatility faded, headlines moved on to other stories. Then, within the span of 2 trading sessions, that quiet pattern broke, and the shift did not go unnoticed by those who track precious metals closely. Gold was the first to signal the change. For nearly 5 months, the metal had been trading beneath a persistent downtrend line, a technical ceiling that repeatedly capped rallies and frustrated bullish positioning. That ceiling gave way. Gold pushed through the trend line, retested it successfully from above, and then extended the move by roughly $300 in a matter of days. In technical analysis, a successful retest after a breakout is considered one of the more reliable confirmations that a trend has genuinely reversed, rather than producing a temporary spike destined to fail. Silver followed, and its structure told an even more compelling story. Analysts pointed to a wedge pattern that had been building since late January, a period of price compression where silver traded within a narrowing range. Wedge patterns are watched closely because they represent a market in tension. Buyers and sellers reach a temporary equilibrium, but that equilibrium cannot hold indefinitely. Eventually, the price is forced to resolve in one direction. Silver resolved upward, breaking out of the wedge and clearing short-term resistance near $63 per ounce. That level matters. A descending trend line extending back to late January had been capping silver's rallies for months. Clearing it did not just represent a short-term win for buyers. It removed a technical obstacle that had been suppressing upside momentum since the beginning of the year. Beyond the immediate breakout, a longer-term pattern has drawn attention from technical analysts, a cup and handle formation on silver's chart, one of the more statistically reliable patterns in technical analysis. This particular formation began building as far back as 1980, with the base of the cup forming over decades, and a handle developing more recently as prices consolidated after reaching record highs last year. The principle behind this pattern is straightforward. The longer the formation takes to build, the more significant the eventual breakout tends to be. Analysts who track this pattern have used the depth of the cup, measured from its baseline to its lowest point, to project a potential future move once the handle breaks out. That projection points toward a target price well above where silver trades today, though the timeline for reaching it is measured in years, not weeks. Gold's structure offered a parallel story through a different lens. Chartists identified what is known as a bull flag, a pattern formed when a sharp price surge, referred to as the flagpole, is followed by a period of consolidation that drifts slightly downward, forming the flag itself. The setup that unfolded in gold and silver at the end of last year and into the first months of this one fits that description closely. A powerful rally formed the pole. The consolidation that followed, extending through much of this year, formed the flag. The recent breakout above that flag's upper boundary is the trigger technical analysts watch for, and the general principle holds that the subsequent move often mirrors the size of the move that formed the pole in the first place. None of this activity occurred in isolation. Trading volume, a key ingredient in validating these patterns, had been notably subdued throughout the consolidation phase on major commodity exchanges. Low volume during a consolidation period is generally viewed as healthy, since it suggests the market is resting rather than distributing, setting the stage for a more sustainable move once the breakout occurs. Taken together, these technical signals describe more than a single strong trading day. They describe a market that spent months building pressure through well-established chart patterns, patterns that professional technical analysts consider among the most predictive available, and then released that pressure through a confirmed breakout across both gold and silver simultaneously. The significance of this alignment should not be understated. When multiple independent technical structures across 2 related but distinct metals confirm the same directional shift within the same short window, it strengthens the case that this move reflects a genuine change in market structure, not short-term noise driven by a single news event. What comes next depends heavily on the macroeconomic backdrop reinforcing this technical picture, and that backdrop deserves equally close examination. While the technical picture explains why gold and silver were primed to move, it does not explain why the breakout happened when it did. For that, attention turns to a cluster of economic data releases that arrived within a compressed window, each pointing in the same direction and each reinforcing the case that the broader economy is losing momentum. The first signal came from private payroll data, which showed job creation falling well short of expectations. Businesses added far fewer positions than economists had forecast, and the shortfall was significant enough to shift market expectations almost immediately. Payroll data carries particular weight because it feeds directly into how policymakers assess the health of the labor market, and a weaker than expected reading tends to lower the probability that the Federal Reserve will continue tightening monetary policy. That reading did not stand alone. A separate measure of job openings, tracked through a widely followed labor turnover survey, also declined, indicating that employers were posting fewer available positions, even before layoffs or hiring freezes became visible in the top-line numbers. Falling job openings are often viewed as an early warning sign, since they tend to soften before unemployment rises, giving analysts a preview of where broader labor conditions may be headed. Manufacturing data added another layer to the picture. A closely watched index measuring the health of the manufacturing sector came in below expectations, with the underlying employment component inside that report showing particularly sharp weakness. Manufacturing tends to react to economic slowdowns before service-based industries, making this figure an important leading indicator. Taken together with the payroll and job openings data, a consistent narrative began to emerge. Economic activity is cooling, and it is cooling in ways that extend beyond a single sector or a single data point. Currency markets responded in kind. The dollar index, which measures the greenback against a basket of major foreign currencies, slipped below the psychologically significant 100 level. A weaker dollar historically correlates with stronger precious metals prices. Since gold and silver are priced in dollars globally, and a declining currency makes those metals cheaper for foreign buyers, while simultaneously reducing the opportunity cost of holding non-yielding assets. Geopolitical developments contributed additional uncertainty. Ongoing tension surrounding shipping routes in the Middle East, along with unresolved questions about regional stability, kept a layer of risk premium embedded in commodity pricing. Markets generally treat this kind of geopolitical backdrop as a reason to maintain, rather than reduce, exposure to traditional safe haven assets. Perhaps the most consequential shift, however, occurred in interest rate expectations. As the weaker economic data accumulated, market pricing for future Federal Reserve rate hikes adjusted accordingly. Where investors had previously priced in the possibility of additional tightening before year-end, that probability fell sharply following the data releases. Lower expected interest rates reduced the opportunity cost of holding gold and silver, both of which produced no yield of their own, making them more attractive relative to interest-bearing alternatives when rate expectations soften. All of these threads point toward a single underlying condition that has defined much of this economic cycle, a combination of slowing growth alongside persistently elevated price pressures. This condition, commonly referred to as stagflation, creates a uniquely favorable environment for precious metals. Traditional stock and bond portfolios often struggle to perform well when growth stalls and inflation remains sticky at the same time, since neither asset class is well suited to hedge against both forces simultaneously. Gold and silver, by contrast, have historically served as a store of value precisely in these conditions, insulated from the erosion that inflation inflicts on paper currency, while offering a hedge against the kind of economic softening reflected in the recent data. This is the backdrop against which the technical breakout occurred. And it is a backdrop that deserves close attention as additional economic data, including the closely watched monthly employment report, continues to shape the outlook in the days ahead. Beyond the immediate breakout lies a much larger question, one that separates short-term traders from investors thinking in years rather than weeks. How far could this move ultimately extend? To answer that, technical analysts turn away from daily price action and toward a chart pattern that spans not months, but decades. The formation in question is known as a cup and handle, and among technical analysts, it carries a reputation few other patterns can match. Unlike shorter-term setups that form and resolve within weeks, this particular pattern on silver's long-term chart traces its origins back to 1980, the year silver last approached the record territory it would not revisit for more than 4 decades. From that peak, the metal spent roughly 3 decades carving out the rounded base of the cup, bottoming and gradually recovering in a process that stretched across multiple economic cycles, multiple decades of monetary policy shifts, and generations of investors entering and exiting the market. More recently, following a strong rally that pushed silver to its highest yearly close on record, the metal entered what analysts describe as the handle, a shorter consolidation phase that typically forms in the final stage before a pattern resolves. The recent breakout marks the point where that handle appears to be completing, and it is this completion that has renewed attention on what the broader cup and handle formation implies for long-term price potential. The methodology behind projecting a target from this pattern is rooted in a straightforward principle used across technical analysis, measuring the depth of the base and applying that same magnitude to the breakout point. In this case, the distance between the cup's baseline and its lowest point represents an extraordinarily large percentage move, and applying that same proportional move from the handle's breakout level produces a long-term target substantially above current prices. Analysts who favor this approach generally emphasize two additional principles that support its credibility here. First, the longer a cup and handle pattern takes to form, the more statistically significant its eventual resolution tends to be, and few patterns in any market span more than 4 decades. Second, this particular pattern is considered one of the more reliable formations in technical analysis precisely because it reflects genuine, sustained shifts in supply and demand rather than short-term speculative positioning. It is important to frame this projection accurately. Analysts who cite this target are not suggesting the move happens quickly. Estimates for when this level might be reached generally extend a decade or more into the future, placing the projection well into the mid-2030s under most interpretations. This is a long horizon thesis, built for investors thinking in terms of structural wealth preservation rather than short-term trading gains, and it should be understood as one interpretation among several professional viewpoints rather than a guaranteed outcome. Supporting evidence for sustained long-term demand can also be found outside the charts. Physical premiums for silver in markets such as India and China have remained persistently elevated compared to Western exchange prices, at times reaching meaningfully above the base market rate. This kind of sustained premium reflects genuine physical demand rather than speculative futures positioning, and it suggests that appetite for the metal extends well beyond traders watching short-term price charts. What makes this long-term case compelling to serious investors is not the size of the projected number itself, but the consistency between multiple independent signals. A historically reliable multi-decade chart pattern, sustained physical demand reflected in global premiums, and a macroeconomic backdrop of persistent inflation that has historically supported precious metals over extended periods. No single data point proves the thesis on its own. Together, they form a case that a growing number of analysts consider difficult to dismiss. Whether this long-term target materializes on the timeline projected remains uncertain, and investors should treat any decade-long forecast with appropriate skepticism. What is less uncertain is the structural argument underpinning it, one built not on speculation about tomorrow's headlines, but on patterns that have taken more than 40 years to form. While retail attention tends to fixate on the spot price of gold and silver themselves, a quieter and arguably more telling story has been unfolding in the mining stocks that produce them. For investors who study market cycles closely, the current state of this sector represents one of the more striking disconnects between price and underlying value seen in years. Mining equities tied to gold and silver have declined sharply from their highs earlier in the year, with many individual silver mining names down well beyond the broader pullback in the metal itself. In some cases, share prices sit 40, 50, even 70% below their January peaks, despite the metals they produce trading near historically elevated levels. This divergence between a strong underlying commodity and a weak equity sector built around producing that commodity is unusual, and it has drawn the attention of veteran contrarian investors who specialize in identifying exactly this kind of mismatch. One such perspective, offered by an analyst who has tracked mining equities for decades, framed the current environment in stark terms. Current valuations, when measured against 50 years of historical data, sit in the lowest quartile ever recorded. Sentiment toward the sector, by most available measures, sits near its weakest point in that same historical window. For a contrarian investor, that combination, depressed valuations paired with depressed sentiment, is not a warning sign. It is closer to the definition of opportunity, since markets historically offer their most favorable entry points precisely when pessimism is most widespread and least justified by underlying fundamentals. Sentiment data offers additional context for why this setup has developed. Following a sharp price run and subsequent pullback earlier in the year, investor psychology around mining shares turned unusually negative, even by the standards of a sector known for volatility. That negativity has only recently begun to ease and, by most measures, remains far below where it would be expected to sit, given current gold and silver prices. This gap between price and sentiment is itself a data point worth watching, since sentiment extremes, whether excessively bullish or excessively bearish, have historically preceded meaningful reversals. A broader structural chart reinforces this picture. When measured as a percentage of total global equity markets, the mining sector currently represents a historically small share, a fraction of where it stood during prior commodity cycles decades ago. At its peak in the 1970s, mining represented a far larger proportion of global equity value than it does today. Even using a more recent comparison point from just over a decade ago, the sector's current share suggests significant room for capital inflows before it would even approach levels considered normal by historical standards, let alone the elevated levels seen during previous bull cycles in precious metals. This matters because capital flows tend to follow attention, and attention tends to follow price performance. As gold and silver continue drawing headlines, generalist investors who have historically ignored the mining sector may begin allocating capital toward it, not because they have deep expertise in geology or production costs, but because rising metal prices tend to eventually pull broader interest toward the companies that produce them. Historically, this kind of rotation has been a defining feature of precious metals bull markets, often arriving well after the metals themselves have already established a clear uptrend. None of this guarantees that mining equities will outperform in the months ahead, and the sector carries risks distinct from owning physical metal, including company-specific operational and geopolitical exposure. But for investors focused on the broader structural argument, the current combination of depressed valuations, historically weak sentiment, and a shrinking share of global equity markets presents a setup that contrarian-minded analysts consider difficult to ignore, particularly when viewed alongside the technical and macroeconomic signals already reinforcing the case for precious metals more broadly. Taken individually, each piece of this story carries weight. Taken together, they form a picture that few single data points could construct on their own. A confirmed technical breakout across both gold and silver. A macroeconomic backdrop of slowing growth paired with persistent inflation. A long-term chart pattern spanning more than 4 decades, pointing towards substantially higher prices over the coming years. And a mining sector trading at valuations and sentiment levels rarely seen, even by the standards of a historically volatile industry. Each of these threads reinforces the others, and that convergence is precisely what separates this moment from an ordinary trading day. It would be a mistake, however, to treat this as a straight line upward. Markets rarely move in a single direction without interruption, and precious metals are no exception. Even within a confirmed uptrend, pullbacks remain not just possible, but likely. Profit-taking after a sharp move, shifts in short-term sentiment, or economic data that temporarily complicates the current narrative could all produce periods of consolidation or retracement. Investors who expect uninterrupted gains often abandon sound long-term positioning at the first sign of volatility, precisely the moment when patience tends to matter most. Understanding this distinction between short-term noise and long-term structure is what separates a well-informed investor from one reacting purely to headlines. This is also where the difference between short-term speculation and long-term strategic positioning becomes most important. The technical and macroeconomic signals described here point to a structural shift, not a guaranteed short-term windfall. Investors chasing rapid price movements often find themselves whipsawed by the very volatility that defines commodity markets in the short run. Those focused on the underlying structural case, the decades-long chart pattern, the macroeconomic conditions historically favorable to precious metals, the valuation gap in mining equities, are positioning for a different kind of outcome, one measured in years rather than days. History offers some perspective here as well. Prior periods of stagflation, currency devaluation, and monetary uncertainty have consistently driven sustained capital rotation toward gold and silver, not as speculative trades, but as stores of value when confidence in traditional financial assets erodes. The current data, weakening labor markets, softening manufacturing activity, a declining dollar, and elevated inflation expectations, mirrors many of the conditions that have historically preceded extended periods of outperformance for precious metals. This is not a new phenomenon. It is a pattern that has repeated across multiple economic cycles, and the current setup shares meaningful characteristics with those earlier periods. What separates this moment is the alignment of factors happening simultaneously. Technical breakouts occur regularly and do not always coincide with supportive macroeconomic conditions. Favorable macro backdrops emerge periodically without a corresponding technical confirmation. Undervalued mining sectors exist at various points without broader metals momentum to accompany them. The rarity here lies in seeing all three align within the same narrow window, a convergence that historically has preceded some of the more significant moves in precious metals markets. For investors evaluating what this means for their own positioning, the takeaway is less about predicting an exact price target and more about recognizing structural conditions that have historically rewarded patience and discipline over reactive decision-making. Wealth preservation through precious metals has never been about capturing every short-term swing. It has been about maintaining exposure through cycles, understanding the macroeconomic forces at play, and avoiding the temptation to abandon a sound long-term position based on short-term noise. The breakout confirmed this week may prove to be an early chapter in a much longer story, one shaped by economic forces that have been building for years and technical patterns that have been forming for decades. Whether the coming months bring continued strength or temporary pullbacks. The structural case outlined here, technical, macroeconomic, and sector-specific, offers a framework for understanding not just what happened, but why it may matter far more in the years ahead than in the days immediately following.